If you know anything about IKEA Group, the giant Scandinavian furniture company, you know that most of their products are made of wood. And you may even know that they're one of the good companies that tries to buy only products that are sustainably harvested. They've pledged that by 2020, 100% of their wood, pulp, and paper will either be recycled or certified by the Forest Stewardship Council as sustainably produced. So far, they're on track to achieve that, according to the Forest Trends Supply Chain Initiative, which tracks the progress that companies report towards achieving environmental commitments. The supply chain entry for IKEA shows the company was 61% of the way towards achieving its 2020 goal as of March of this year. 2 months earlier, my colleague Kelley Hamrick at Ecosystem Marketplace published a report called State of Private Investment in Conservation 2016, which I was flipping through this morning while researching today's show. In so doing, I learned that IKEA has also started investing in forests all across Europe, explicitly to make sure those forests are managed in ways that serve a larger public good, and in so doing, help the company meet its sustainability commitments. As of January, when the report came out, IKEA had purchased about 100,000 hectares of forest in Romania, Bulgaria, and the Baltics, and it had earmarked more than $1 billion more for investing in sustainable forestry. Make no mistake, they're doing this to make money, but to do so in a sustainable way. And that means this qualifies as impact investing, which is any investment that's designed to generate both a profit and a larger public good. The Global Impact Investing Network has identified more than $30 billion of impact investments in the last 3 years. And Kelley's report, which I alluded to above, identified about $8 billion earmarked for impact investments that specifically involve forests, farms, and fields, all of which need to be better managed if our civilization is to survive the climate challenge. Now, $8 billion is nothing to sneeze at, but it really is just a sneeze in a hurricane compared to the $55 trillion global economy. What's more, on top of that $8 billion, another $3 billion was allocated but went uninvested. If you're an optimist like me, that means there's plenty of room for growth. Today we speak with Noelle Claire Lecan and Richard Frenopfel, who run impact investment group AlphaSource Advisors and see big opportunities for people who want to make money by helping the world better manage its forests, farms, and fields in the new epoch that we call the Anthropocene.
Man may be unwittingly changing the world's climate through the waste products of his civilization.
There's a group of us now who are proposing that the Earth has actually entered a new epoch, and that is the Anthropocene.
We know that the enemy is carbon, and we know its ugly face. We should put a big fat price on it, and of course, add to that, drop the subsidies.
Earth, we broke it, we own it. And nothing is as it was. Not the trees, not the seas, not the forests, farms, or fields. And not the global economy that depends on all of these. But we can restore it, make it better, greener, more resilient, more sustainable. But how? Technology? Geoengineering? Are we doomed to live on a bionic planet, or is nature itself the answer? That's the question we address in every episode of Bionic Planet, a podcast of the Anthropocene, the new epoch defined by man's impact on Earth, and your guide to the restoration economy that I believe will help get us out of this mess. The restoration economy needs entrepreneurs and venture capitalists, which is why Noelle Claire Lecan and Richard Frenopfel started AlphaSource Investors. I spoke to them back in May at the Innovate for Climate conference in Barcelona, so you'll hear some background noise, but it's not too bad. I apologize for taking so long to deliver this, but if you want more and more timely episodes of Bionic Planet and better produced ones to boot, consider becoming a patron at bionic-planet.com. I'll tell you more about that later in the show. For now, let's get to it. A year you're a $250 million fund, and you have $30 million so far. Can you maybe tell us a little bit about where that money came from and how you're pitching to outsiders, and also focus a little bit on how much of that money is coming from foundations and how much of it is coming from profit-seeking investors?
They're 100% profit-seeking investors. There's a foundation who's doing a PRI investment with us.
Jargon alert, PRIs are program-related investments, which are investments that foundations make to support activities they believe in, but also to generate a return. I might start looking for some PRI money myself so that I can bring you more and better episodes of Bionic Planet.
They have full expectation of return. However, they happen to be much more focused on the impact, and it's their mission of the foundation. So we're particularly excited about their support because our goals are exactly aligned. Then the other 20 is coming in from high net worth individual who's also hyper-focused on the impact, but expects the market rate return that we're offering. So, and that's very important to us to send out the message because often impact investing is associated with concessionary returns.
Sorry to be back so soon, but concessionary returns need some explaining as well. They simply mean returns that are below market rate, but still positive. So if you invest in a sustainable coffee project, you might accept a lower return than you'd get in a more cutthroat endeavor, but you'll sleep better at night knowing that you're not working poor people to death or contributing to the degradation of forests. I first heard of impact investing from Amy Dominy back in 1999 or so. She's a true pioneer in this field, which is why it's her name on the Dominy 400 Social Index, which launched in 1990. One thing I clearly remember from our conversation was her differentiation between socially responsible investing, which refers to investments that aim to do good and accept a lower return, and sustainable investing, which refers to investments that both aim to do good and expect to outperform the general market over time. The theory being that sustainable investments should have less risk because they invest in companies that treat their people and their land right, so they don't face strikes and lawsuits and other unexpected events. Amy at the time was skeptical of the sustainable investment theory, but she felt it was important to be putting your money where your morals are and accept concessionary returns. Ironically, the Dominy 400 has, in fact, outperformed the S&P 500 by about 0.5% per year over the last 27 years. That adds up.
We believe that impact investments can actually enhance returns and lower risk. So, we want to make sure it's clear that in addition to the impact are market rate returns.
Just to add on that, one of the things that's really important to us is that we're in a space we want to be in. Impact space has always been, in our minds, a place that's very collaborative and very inclusive. Not everybody feels that same way. Some people want to think that they have special sauce that needs to be protected. We think there's plenty of room, and what we want to do is kind of prove out a model. A year from now, when people see that there are non-concessionary returns in a fund that's focusing on something that people haven't really dipped their toe in that pool yet, that others will follow behind us and support the entire market and help us have air to breathe in the future and not be underwater.
Yeah, physically, or but also financially, or parched somewhere inland, which is where you guys mostly work. We'll get into your investment areas shortly, but can you tell us what ponds you're fishing in? Who are your investors, and how do you pitch them?
So, in terms of who we're pitching it, we're just building an ecosystem. So, and that's expanding, as we come to events like this. The folks who have the same goal that we have are the ones who are most receptive to the conversation. However, we also have investors who are not particularly impact focused, but they're just in it for the return. So, it's an ever expanding target audience.
especially with institutional investors, it's really about fitting into the mandate that they have. That might not have anything to do with impact. But it might have to do with a woman-run fund, which this happens to be. Or really whatever gets people to the table and gets the needle moving in the right direction is okay with us.
And in terms of our pitch, we have acknowledged that the forests, for example, in the DRC, are surrounded by communities that can't afford to protect them on their own. So we feel that if someone doesn't help them and we lose that forest, then we've lost the fight against climate change. So our primary goal is to help those communities to become sustainable so they can protect their own forests, so they don't need folks like us forever. We can give them that boost and at the same time create all sorts of alternative livelihoods so that they don't have to also invade their own forests to produce low-value commodities, and at the same time we can be protecting the biodiversity within those forests.
What Noelle is talking about is so right on, is that to the degree that we can come in and help an entire landscape, that sits, let's say it sits around a REDD+ project, but sits alongside sustainable mining or sustainable timber or, forest agriculture, to the degree that we can make those communities and make those businesses within those communities sustainable, right? That's the difference, right? I can sum up the difference right there, is that no one has to come back a year later and put another $1 million in it. We can come in now and support businesses that are investable and that just need some capital to scale and some time and some support, maybe with technology that we can bring in to help them be more efficient, right? Ag tech, Internet of Things technologies, because we've invested in disruptive technologies in the past because we think it's a huge part of impact investing.
And climate smart.
And climate smart
agriculture.
Right? So to us, that's really the whole thing, right? Is that you make these communities, you make these businesses sustainable, and then there's no need for the philanthropic element after that.
That's what drew me to the whole payments for ecosystem services thing. This idea that we were creating sustainable finance by paying for a service that we need and will, therefore, keep paying for, rather than just being philanthropic and doing good that we might change our minds about. Specifically, with payments for ecosystem services, we're, for example, paying indigenous people to manage their forests, which mop up our own carbon dioxide emissions and slow climate change. Or developers who damage wetlands or habitat are paying farmers and others to restore nature, and in ways that more than make up for damages. Richard touched on a phenomenon that I've experienced firsthand with philanthropy, namely, donors like to fund new things, but they don't get excited about existing projects that are generating good results. So you get these waves of well-intentioned finance flowing into new projects based on cool PowerPoint presentations, but you don't get back-end payments flowing into those endeavors that are actually generating verifiable results. Payments for ecosystem services are the opposite. Money usually flows after the forest has been saved or the wetland restored, so the buyer can see exactly what he's getting. I'm trying to do something like that here as well. So far, I haven't gotten any funding for Bionic Planet beyond what you, my listeners, send. Although my employer, Forest Trends, has let me develop these partly on company time because they know that I'm harvesting their research findings and sharing them with an audience that doesn't usually find them. I'm sure you've noticed, however, that these episodes come out irregularly. And if you'd like to hear more and better episodes, you can help by becoming a patron at bionic-planet.com. I've set the patronage page up so that you can support me per episode, but with a monthly cap. So if you think $5 per month is good for a 5-episode month, you can pledge $1 per episode, but with a $5 cap. That way, if I don't manage to generate 5 episodes in a month, you're not paying for something you didn't get. And if I go nuts and deliver 20 episodes one month, you won't get whacked either. By the same token, you can offer $5 per episode or 10 or 50 or whatever. If that's asking too much, you can give me some positive energy in the form of a good rating at iTunes or Stitcher or wherever you access my show, or you can share Bionic Planet with friends. Of course, if I can make a solid enough business case, I might approach some impact investors myself. Which brings us back to the topic of today's show. Now, I mentioned Kelley Hamrick's report, State of Private Investment in Conservation 2016, which you can download via the show notes of episode 21 at bionic-planet.com. Kelley makes an appearance in the second half of today's show because she dropped by while I was speaking with Richard and Noel. In fact, it was Kelley's findings that prompted me to grab them, and here's why. Kelley found that from 2004 through 2015, investors directed $8.2 billion towards projects that preserved forests, protected watersheds, and restored wetlands, among other things. But as I mentioned before, they allocated an additional $3 billion, but left it on the table. We'll address that in the second half of the show, but here's another interesting finding. Most of the money that did get invested went into sustainable agriculture and sustainable forestry, like IKEA's investment, rather than into distinct payments for ecosystem services. Noel and Richard caught my eye because they are going against the grain. If you go to their website, alpharesourceadvisors.com, you'll find they're investing in nearly a dozen REDD projects. REDD as in REDD, which regular listeners know stands for Reducing Emissions from Deforestation and Degradation of Forests. REDD projects use carbon finance to save endangered forests. And you can find out more about REDD in episode 7, called Of Milk and Money. You know, I've been coming to these meetings for years. This is technically the first one that's called Innovate for Climate, but I went to about 8 of the Carbon Expos. And every year we'd hear about this mythical creature, the impact investor, who was going to ride in on a white horse and save the day by recognizing that REDD projects are viable commercial endeavors. But you're the first ones I've ever seen. Now, I look at your portfolio and I see that you've obviously been around a while. You're invested in Wildlife Works and Raya, which are big REDD programs, but I've never seen you at these events, and I was wondering if you could share your impressions with me.
I've been called lots of things in my life. Mythical is not one of them, so that's pretty cool. I like that. Mike Korchinski at Wildlife Works described this event last night as a type of reunion, and that's kind of the vibe that I get from this place. There's people who've been in the space for 20 years or more, and then there's kind of an influx of people, and I guess we're among them, that are coming in maybe, hopefully with an infusion of energy, but that really want to move capital and really want to start making some hay in the space, which I think is only good. We just came out of the blockchain event, which I think has very large implications for the space.
Can you briefly explain what blockchain is?
Oh my God.
Is it possible?
Well, blockchain is a technology, really kind of a platform, a distributed platform. So people talk about the cloud as distributed, but it's really not. The cloud is a server farm somewhere that has risk associated with it because it's in a single place. So it could go down, it could be compromised. Blockchain is basically taking little bits of information and distributing it potentially across millions of computers across the internet. The implications of that, as you can imagine, are limited only by your imagination. A lot of people equate blockchain with Bitcoin as just kind of a currency, but really it's about any digital asset that has an agreement behind it that needs to be enforced digitally. So it potentially takes a lot of the chaff out of the process in terms of different parties that are taking a cut and taking time. So you can kind of imagine that what the implications are there for carbon and what the implications are broadly.
Mm-hmm. Yeah, I missed that panel, so I don't have any questions, but it sounds fascinating. I want to.
Yeah, so I think I said that right. I mean, there are people here who know a lot more about it than I do.
But they're dangerous, though. They start talking and it will never leave.
That's right.
I looked into blockchain, And for our purposes, I'll summarize it as a way of embedding ecosystem values in the cost of a product. But it's actually much broader than that. It was developed for Bitcoin by a person or group of people called Satoshi Nakamoto, which is a pseudonym. And it makes it possible to distribute, but not copy, digital information. Looking at AlphaSource's portfolio, I see a company called Viridium, which was created by Infinite Earth. That's the same company that developed the Rimbaraya Red project that I mentioned earlier. And I've written about them extensively. I'm big fans of those guys, and I will try to get them on the podcast. You were talking earlier about how you got into this in Red Plus, and Red Plus is when you're using carbon finance to pay to save endangered forest. One of the reasons that's interesting to me is we did do this study. Ecosystem Marketplace did a big study a while back, a big survey of impact investors who were explicitly putting money into sustainable land use. And they broke, Kelley Hamrick is sitting here with a pear in her mouth. She's the... She wrote the report. So Kelley, you can just tell me if I'm getting anything wrong and wave, okay, I can hand it over to you when you finish. As I recall, the key finding on this was that there was $8 billion, right, flowed into sustainable land use, of which $5 billion went into
Sorry, I don't remember the numbers off the top of my head, but it was $8.2 billion tracked over 12 years. But what I think was the most significant finding was that we had tracked another $3 billion. A little bit more than that, I think, that had been committed but not yet deployed. So it was sort of waiting in the wings, so that just, to us at least, meant that there was really huge potential for really scaling up the market quickly.
Most of it went into fairly standard agriculture projects, but that were done in a sustainable way. And then a lot of it went into sustainable forestry. There was very little of it going into things like Red Plus. And maybe you can flesh those numbers out.
It might have been around $5 billion to sustainable agriculture and forestry. And we had a couple thoughts on that. I mean, I think part of it is just because those types of investments have been around longer and people are more familiar with them. Also, just in terms of the size of those investments are usually quite large compared to, some of the other different types of conservation that we were tracking that might have been smaller scale. So I think it was probably a mixture of both. But as far as forest carbon markets, there aren't a whole lot of compliance markets that allow for forest carbon projects in them. So a clear source of demand really hasn't yet materialized, at least on a lot of the compliance markets. And as far as the voluntary carbon markets, I think that's just inherently more risky because, there's never any clear source where you can go find a pool where you know that there are going to be voluntary carbon buyers. So that might be something where even impact investors are still a little risk averse.
So just to summarize, that very small amount of money that we tracked ended up in these types of distinct payments for ecosystem services like Red Plus or biodiversity offsets. And we assume it's because it's for two reasons. One could just be that they don't understand these investments, investors don't. And the other could be that, hey, maybe the risk is just too big. The risk-reward ratio isn't there. Then you can take it from there.
Yeah, so there's certainly no dearth of projects, investable projects. However, there is a lot of capital in the wings because, just like you said, they don't have the mandate for direct investments into Red Plus developers or even credits. So, they don't have the right risk-reward mandate. So that's where we've come in to fill that void because we've had those very investors, those institutions looking for that type of impact. In order to get it, they need a mitigated risk platform over a diversified array of projects and investments.
Jargon alert, a mitigated risk platform means essentially that they're trying to identify all of the potential risks that their investors face and then either trying to reduce them in ways that we'll explore shortly or bringing in governmental agencies and others to act as guarantors. Ultimately, however, risk management is about doing your homework and knowing the lay of the land.
More broadly, there are due diligence factors that are problematic for a lot of people out there. I mean, you need to be very strategic in who you partner with. As we build out our team, we have a partnership with the Rainforest Alliance, which has 1.4 million smallholder farmers and 4,000 offtake agreements out there. So, in terms of boots on the ground, there's idiosyncrasies to all of these projects that we're talking about going into, and I think that's problematic for a lot of investors who want something that's a little more cookie cutter to make them feel safe. So we feel like it's very, very important for us to be partnered with people who are boots on the ground, who've been there for a long time, who understand where things could go wrong that you might not think of unless you really, really had intimate knowledge of a local knowledge.
Mm-hmm. And that's very similar to, do you know the Livelihoods Fund?
I've heard of it, but okay. I don't know too much about it.
Well, it's a fund that Dannon started, and it's since spun off, and they're also doing they're partnering with local NGOs, and they're very, very it took years to find out the ones that they trusted, and seeing the work that they've done in Kenya. I've done other podcasts on that. I think it was episode, I forget which, I'll splice it in, but that's episode 7 again, which was meant to be the first of a 2-parter. If you listen, you'll hear that it's a feature package and not a straight interview. I actually think these features are the best way to tell a complex story, but they take a lot of time that I just don't have. Another reason for you to help me, either by dint of a good review or by becoming a patron at bionic-planet.com. It's really fascinating to see how complicated these things are. And you mentioned uptake agreements. I'm not sure everyone knows what an uptake agreement is unless they heard that specific podcast. Can you maybe talk a little bit about that, one of you?
With an offtake agreement, which is just an agreement for a certain commodity. So, for example, Whole Foods would be one of the important clients of Rainforest Alliance who could come to the table with an order, and then we can reach out to some of these smallholder farmers and have an order in hand. So it's pre-sold, so they can plant a higher value crop, knowing that they don't have to deal with marketing and selling that crop because it's pre-sold.
Right. Yeah. I mean, you're basically shrinking the supply chain there. One of our areas of concentration geographically is Indonesia. We were just there last month, and they had a ton of pilot programs within this project that were there, and they said, "Oh well, let's see if we can plant pineapples and see what happens." Well, of course, in Indonesia, any seed that falls out of your pocket is going to grow, right? So we don't really need to worry about whether or not it'll grow. What we need to do is make sure that we have potentially high-margin product, and that they have, as Noel said, an agreement in hand that says, you know what, if you grow this, we'll buy it. Right? It's brilliant, but no one's really been doing it, and that's where I think this kind of partnership for us really bears fruit, no pun intended. Yeah.
That whole issue of offtake agreements, I think I called it an uptake agreement before, that was a huge epiphany for me in Kenya, seeing how these small farmers with 4 acres, and you had a dairy company, Brookside, they needed to make sure they had more milk, and they went to the farmers. They said, "What can we do?" And the farmers basically said, "Look, all we want is to know that if we make it, you will buy it. We don't even need a guaranteed price." And that changed everything. And that kind of goes into something else that came up yesterday. Someone on one of the panels, I forget who it was, there was a question about what's the lever that's going to get this finance flowing. And the answer came back that the lever was the risk-reward factor, adjusting, moving that, and lower the risk and increase the reward. And it's easy, yeah. So let's just do it. But it is interesting to see how it is an incremental thing, and it is so complicated.
Well, it's interesting what you're saying, because for large institutions, it just has to be within their definition of acceptable risk. So sometimes even a small mitigating factor for risk can bring you into that area where it becomes possible. So, and that's what we've done. So, we've taken it from a place of impossibility to a place of possibility for some of these institutions who otherwise it just wouldn't be within their mandate.
And let me kind of go back to where we started, which was that you're investing also in these programs like Wildlife Works. They weren't the first group to do RED, but they were the first to do it successfully and commercially.
They were the first certified.
Yeah.
First certified under VCS, I think.
Yeah.
And but they weren't just the first certified. They've been very successful.
Yeah.
They know how to market. And what drew you to them?
They have a 20-year track record, and we've seen the impact that they've created and the trust that they've earned in this community. They've already put down some infrastructure.
20 years of activity within the community, but not 20 years in RED. They were doing sustainable.
That's right.
Clothing or something, right?
Correct. Yeah.
They've done sustainable clothing, soap, They have a variety of different projects, and of course they've saved thousands of elephants, and they've created a barrier. So they've eliminated the farmer-elephant conflict. It's just amazing what they've been able to accomplish.
That's really what I love about that project is it was something that was completely mission-based, right? Mike got there 20 years ago, and because he loved elephants, and he saw what they were doing in terms of conservation there, this fence and shoot type of conservation, which was problematic and awful, and he said, okay, I've got to do something about this. And everything kind of grew organically from there, right? So he opened up every revenue stream that he could, whether it was, textiles or soap or baskets or whatever, to keep that afloat. But it was always with an eye towards respecting the community and giving back into that community and making sure that they were taken care of. That's one of the things that I really love about RED and how they're now aligned with the SDGs, and that there's a component of gender equity into it.
Just to clarify, SDGs are the Sustainable Development Goals. There are 17 Sustainable Development Goals, and they're broken into 169 targets, and every country in the world agreed to structure financing around them, which makes them a pretty big deal. Billions of dollars in finance are now tied to the SDGs, and I covered them in episode 5 of Bionic Planet, where we heard from this guy.
My ideal goal will be that everybody will run its business plan and its objectives along the Sustainable Development Goals, that we would actually publish our annual reports to show what contributions we make to the Sustainable Development Goals.
That's Paul Pullman, chairman of Unilever, which is just one of the companies that is building its business strategy around the SDGs. AlphaSource also builds its entire portfolio around them. And a few years back, Ali Goldstein wrote a report for Ecosystem Marketplace called Not So Niche: Co-Benefits at the Intersection of Forest Carbon and Sustainable Development, which identified a powerful correlation between forest carbon projects and the SDGs. You can find a link to the report in the show notes for this episode, episode 21, at bionic-planet.com.
But everything about Wildlife Works, to me, is a lovely story about saying, okay, this isn't working, so I'll pivot, but always with respect to the community first, and respecting the idiosyncrasies, and that's what we want to bring to, moreover to this space, and how we're going to allocate our dollars.
When I hear people criticizing RED, there's a lot of ideological resistance to it, and there are some things that mechanism needed to be improved on. But one thing that I've always found annoying, and I hope you agree with me because I just said it's annoying, but when they talk about RED as an incentive to get people to change, I just don't see it as that. And the reason is this. Let's say you're in Indonesia and you have a choice. Okay, am I going to do palm oil or am I going to do RED? The difference between what you'll earn by chopping the forest and putting in a palm oil plantation and what you'll get from RED. I remember I did the numbers once, and it's just the multiples. I always look at it more as an enabling mechanism, because whenever I see people doing RED, they're not doing it to get rich or to make money. Money is not their primary goal. They're doing it because they have something they want to achieve, and the money that RED brings enables them to do it. It aligns things properly. It makes it so that you can make money off of the forest by doing the right thing, by keeping it alive. But their earnings still are not what they would be if you chopped it and sold everything off, and they may never be. I wonder if you could just comment on this whole idea of framing it. Just calling it an incentive seems to invite this kind of critique.
Well, what you just said is there's an element of it that is true, actually. So, for example, we met a fellow who supports the tribes who still kill elephants. Mm-hmm. And that's a behavior that we don't want to support, right? So, but to your point, we're trying to change that behavior. And his argument was, well, they should be allowed to kill elephants, So RED is about biodiversity and protecting certain wildlife. But for folks who do want to kill elephants, that will create some conflict. And so what RED has enabled, for example, Wildlife Works to do is to provide alternative lifestyles or alternative livelihoods for people who had relied on being elephant hunters in the past. So and in his community, there's no problem with that. But if you're talking to someone whose father and grandfather and great-grandfather did that, initially there can be some pushback. So that could be a matter of perspective, but we've come to a place on this planet where it's not sustainable to kill elephants indefinitely. So even if you did believe in that, which I don't, but if you did believe in that, that's not a livelihood you can pass on to your grandchildren now, because there won't be elephants left. So there's really no argument for that anyway. But that would just be one example of where you can get pushback.
And of course, most places it's illegal now. So there's that. But I'll answer your question, I guess, with an anecdote. So we recently had someone in our office who has a huge, actually multiple concessions in the DRC, on which he's been doing timber, and not sustainable timber in his family for a long time. And his kids had pressured him to convert, and he's now in the process of with the help of, I think, some project developers who've already been out there in the space, converting to RED+. So I think there are other factors besides just financial and legal and what have you, that are pushing people towards RED. And I think the finances are different depending on the geographies that you're talking about. And in terms of what's going back into the communities themselves, I think the communities are much better served by RED. Maybe the developers themselves could make more. But to your point, most of them are in this for the right reasons to begin with.
One issue that I've always found a little bit frustrating, because I come from the private sector as well, and I started out in trading, and then I went into media, and now I'm here, and I found when I first got into this, it just seemed that everything was way slower than it needed to be. I found it incredibly frustrating and ridiculous. And then as I came to understand, especially on the climate talks, how complicated it is to get to almost 200 countries to agree on 4,000 little points like that. I mean, as I came to understand the complexity of it, I began to really appreciate the slowness and the need for that kind of meticulousness. And I kind of feel it's some ways I became part of the problem, because suddenly I came to understand the problem almost too well and wasn't doing anything to move it forward. But at the same time, you have to have those ducks in a row if people are going to be able to come in with money and finance. Do you have the same perception? Is this accurate? And second is, do you have any thoughts on how we can work through it?
Yeah. So we launched in 2007. So we feel your pain in terms of frustration, and we really expected a much bigger response. We were very lucky in that we had foundational investors who just cared about the impact, and they carried us along, and we survived. But I'll tell you, in the last 3 years, we've seen such an upsurge in support, and particularly institutional support. So it's a complete turnaround. So we're really encouraged. Obviously, what happened in Paris was a key domino that had to happen, and we're thrilled with that. And in the meantime, now we've been at the table with some talk of some really big numbers coming into the RED+ market. So we couldn't be more optimistic than we are about where it's headed.
I mean, I think we like our timing, and for exactly the reason you said, is that certain things from a policy standpoint, from a regulatory standpoint, had to happen, and had to happen kind of slowly, right? Here's the VCS booth right here, right? These guys had to come in, had to create something that was recognized and replicable. That's just one example, obviously, but I feel like we're coming in at a great time, especially on the heels of Paris, which is now 2 years ago. Frameworks are in place. We can come in and be a little more rah-rah and say, hey, let's go, rather than if we had come into this 7-8 years ago, where we'd still have to kind of hurry up and wait. Mm-hmm. So, to your point, yeah.
We've also had many meetings and conferences before this where they debated the definition of impact and whether it was even possible, and if there was any hope that it would ever work. And so now we're beyond that, and people, this is now an ecosystem, and we've seen a lot of collaboration at this conference, which has been very nice to see, and so we think it's headed in the right direction.
Yeah, absolutely. And in other, Noel talked about how we've been in the impact space, and whether you're here talking about carbon or whether you're talking about social impact or other impact conferences that we've gone to in the States, which is really lagging. As Noel said, there's a lot of hand-wringing. There's a lot of people out there saying, okay, what's our definition? There's a lot of policymakers. There's a lot of academics who are saying, oh, let's get our terminology right. What I'm seeing lately is that there's kind of a younger generation now coming in, this millennial generation that they don't see these barriers that we've put up. They just say, well, this doesn't make sense, so let's do this. And I see it's actually kind of working, So I think there's an energy right now overall in the impact space of saying, this is just not the way you do it. I read an interesting stat, I don't know if it's true, but that some ungodly percentage of millennials are vegan and vegetarian, like 47%. It's amazing, all right? But that just shows you the direction that we're going. I mean, that's a figure that if you had told me that 10 years ago, I would have said you were insane. But it just goes to show you that people are voting with their wallets, and they're using whatever arrows they have in their quiver to make change, whether that's going to their local grocery store and buying something that's local or sustainable or has the Rainforest Alliance frog on it, or whether they're here at Carbon Expo trying to move money into an area that desperately needs it.
If I'm an entrepreneur and I've got an idea and I'm doing something that I think is a real sustainable program project, what do I need to have? What ducks do I already have to have in a row before I approach you or someone like you guys?
So that's a really great question, because if someone is conserving a forest, they don't need to be REDD+ certified for us to sit down with them and talk about how we can help with a landscape approach. So I guess the answer is someone who is going down that path, we'd be delighted to share what we've learned and how we can be helpful if we can. So there wouldn't necessarily be criteria.
Yeah, that's right. I mean, anything that we deem investable, we'll happily look at, and it's across the capital structure. So, if they're seed stage, if it's just an idea, we may not say, okay, we're ready to invest in you, but we're happy to help them and put them into a place where they can be successful and follow their progress and hopefully get them to a place where they're investable somewhere in the future through the fund.
Richard Fernapfel and Noelle Claire Lecan wrapping up this edition of Bionic Planet. And again, if you like what you hear, be sure to share Bionic Planet with friends and give us a good rating on iTunes, Stitcher, or wherever you access podcasts. You can also help by becoming a patron at bionic-planet.com, where you can show your appreciation for as little as $1 per month. In our next edition, we'll be speaking with His Excellency Ronald Jumeau, Seychelles Ambassador for Climate Change. He worked with the Nature Conservancy's NatureVest initiative to develop the first debt swap for helping small-scale fishermen sustainably manage their fisheries. It's one of these really important stories that can get kind of wonky, but he explained it to me incredibly well, and I'll try to make it even clearer by snipping out the digressions and dropping in little interjections when it gets confusing. By the way, how do you like this format? I've gotten good feedback on these interjections I've been making. Do they help you, or are they distractions? Any feedback is welcome, and you can reach me at steve@bionic-planet.com. Once again, that's steve@bionic-planet.com. Until next time, I'm Steve Zwick in Chicago. Thanks for listening.